the people who couldn't make it will be able to listen to it later. Thank you, everybody, for being here. And I'm going to share my screen. Okay. So tonight is all about finance. Usually I don't do much with the financial side of retirement because that's not my expertise. So I like to bring in other people whose expertise it is. And that's what we're doing tonight. So Retire Happily is my company, and it's all about designing your joyful retirement. Through our feisty and fearless over 50 circles and one-on-one coaching and our interviews like today, we help you navigate the transition to retirement. And there's a whole lot to think about. The biggest questions about retirement are when to retire, what to do when you do retire, who are you going to do it with? Because your colleagues are still going to be working. Where are you going to live? Are you going to stay in the same house or are you going to move? How are you going to stay fit and healthy? It's not going to be sitting on the couch. I'll give you that hint. And what about being single and retired? And the later years are also things that need to be considered. This afternoon, we have Dave Hutchinson. And just to tell you a little bit about Dave, he joined Triad in 2013 after working at larger investment consultants and investment management firms. He also founded his own investment firm in 2005, which was his favorite time as it enabled him to bring his bigger firm experience to help his clients. He graduated from McAllister College and USC's Marshall School of Business. And while he was at USC, he was part of a select group of students assigned to manage a small portion of the school's endowment fund. A pretty big thing, I would say that is. He's a member of Care Optima Health's Investment Advisory Committee, as well as some other professional groups. And he lives with his wife, Brooke, and their two sons, Charlie and Tommy. So let me stop there. And Dave, welcome. And yeah, good to have you with us. And I know when I'm talking to somebody about my finances, it's such a big deal. Let's face it, how money is. So I really want to know who they are. So tell us a little more about yourself and how you got into this field.
Sure. Thank you, Pauline. Thank you for having me as part of your series. Good to be here. And thanks for everybody for attending. I've been interested in terms of what I'm doing right now. It's been a part of my life since I was in college. I became interested in investing through a mutual fund. I was wondering why they picked the stocks they did. And I'm just interested in it in a very sideline way. It wasn't what I focused on in undergrad college. I went to college in McAllister, which is in Minnesota. So to give you a point of reference. So cold there, got a hot summer. And I stayed there. I'm from Portland, Oregon originally. But I went to college there because I liked the program and I made a lot of good friends. And one of the things I did was stay afterwards. And I started my career right in that area. And I was fortunate to join a firm that's now called Ameriprise Financial, which is a pretty big firm. It had a different name back then. It was owned by American Express and a lot of different corporate iterations. But I was there and I got to enter the investment business at a basic level. And I worked in the investment department and helped understand strategies worked and how investing worked a little bit. I asked around when I was there and I said, I want to get in. I'd like to do what you're doing. I'm reading about it and helping in the marketing side. I'd like to be an investor myself. How do I do it? So they said, get an MBA. And they also said to get what's known as a CFA, Chartered Financial Analyst designation. So I did both of those things over the next couple of years. I moved to Los Angeles and went to USC and was part of their investment program there. And pursued the CFA designation, which is a designation that's not as well known as some, but it's a difficult one to get, focused more on investment. Like you can think of it as a portfolio manager's designation. So someone that picks individual stocks and bonds, things like that, often has that designation as a point of reference. The CFP is another big one that's very common in our industry, and they're both really good. I have the CFA, and I give you a short cut to the chase a little bit. After I went to USC, I went to a big investment firm in the Bay Area, got a job there as an analyst, studied stock, all this kind of stuff. But what I ended up wanting to do was to work with individual clients and manage portfolios. So I did that by starting, at the time, my own very small firm in the Bay Area, as you mentioned in my bio. And then it was too small. It wasn't enough people. I was one person. I had to do all the jobs, and there's not enough time to do all the things you can with a small amount of money and no other people. And that I should say that the technology in 2005 was a lot more crude than it is now. You could run something yourself, I think, now with one person. There's so much automation and things like that. So I did that, and I realized it wasn't going to work. And my wife's from Orange County originally, so we used all of those things to say, let's move back here and explore opportunities here. And I was fortunate enough when I did that to meet my partner, John, who had started his own firm about the same time I had, just a couple of years later. And we partnered up about 11 years ago, and I've been working with him ever since. And we're both I would say we both have worked at bigger firms and have a lot of experience. He's a little bit older than me, so he has even more experience. And we bring all that together to help our clients. And that's why he founded his firm for the same reason I did. So you could focus on what clients want and not on the bureaucracy of a big firm. So that's why we started our firm. And we both love working with our clients. And with automation, it doesn't take very many people. We only have 3 people, but we have so many things that are outsourced or run, very efficiently by computers that it worked very well. And we can focus all our time on talking with people and talking with clients.
That's great. Great. Thanks for that background, Dave. I work in helping people to retire. I work with both men and women who are looking to make the transition to retirement. And there are differences between the way men approach it and the way women approach it. What, in your experience, do women invest differently than men? Do they have different concerns?
I'd say everybody I work with, and we work with a pretty wide variety of situations. I'd say the stereotype in our industry is that women are not treated well by advisors in general, in terms of if it's a couple. I've read far too many things that have said that the advisor default talking to the husband does not talk to the wife, does not build a relationship with the wife. There's a lot of situations where that you can see that happening, and we do not operate like that at all. We don't believe in it at all. I'd say there's no way to overgeneralize, but I would say we work with a lot of women where they're either the primary contact or the only contact that we work with. And I wouldn't say there's any big differences. It really comes down, any investing is dealing with our brain and our preconceptions toward making mistakes. Investing isn't a natural activity for what we have evolved to become. I think of it as when you see red numbers on the screen on CNBC or negative numbers on your statement that you get. A lot of people manage by statement. They get a statement in the mail, and that dictates how they feel about things. When you do that, we're trained to run away from problems through evolution, I would say. So when we see red numbers for things, we think of that as a problem. We should run away. We should sell, or we think it's going to get worse, or it's like a fire or something like that. It's like things that we can relate to. And it's really not. It's more like you've gone to Costco and suddenly they've said that things were already cheap. And then they've done that thing where they say, if you use the coupon, it's another $5 off for that item. That's what it is. When numbers are down and when people are pessimistic, when you say, I have to invest for the next 25 or 30 years, what happened today, if it made things a little bit cheaper, that's good for me. It's not bad. Ultimately, that's what matters, regardless of your gender, is getting through these things. And these feelings are completely normal. You should not repress a feeling. My only job is to get in between someone's feeling and their action in terms of misacting and making a mistake. But to embrace your feeling and to have fearful feelings is completely normal and is part of investing for many people. And for us too, I shouldn't say we're people too. We have the same ups and downs to an extent. We just think about it pretty systematically and you try to come up with ways to deal with it. But that's how we all are.
Right. Yeah, I know when I look at my portfolio and I see, oh, that's gone up, that's gone up. Oh, no, that's going down. Oh, yeah. It's my first reaction. Yeah.
I know. We often, well, you talk to someone and they ask you about 3 stocks. We joke a little bit that those are probably the 3 that haven't done over the last couple months, because that's how we focus. We say, what about those? What's wrong with those? And it's always a mixed bag. There could be something temporarily wrong with it. Think of it as like a head cold versus a terminal disease, but you don't want to necessarily sell and leave that great idea because of a temporary problem. And temporary problems provide us with good opportunities, like I alluded to buy in and become a partner at a cheaper price, which is ultimately when I think about it.
Exactly. Exactly. So recent statistics show that 70% of people in the US are ill prepared for retirement. Often they have a limited amount of funds saved or invested. So for people close to retirement, what's the first piece of advice you would give them?
As we work with a lot of people, I'd say we work with people 50 plus. So I'm always thinking at 50, that's when you're starting to think that retirement will happen. And then we work with people, a lot of our clients are already retired. We work with people that have come aboard as retired people or are literally in the place where you're talking about, where they're going to retire very soon. So you could consider them to be retired. And the way to look at it, the first thing that most people don't have is, I've noticed that people over working a long life and doing what I'd say really good things for themselves, they've saved, they put money into an IRA or a 401k, and often they have a collection of them. I have 3 IRAs. I have a little tiny Roth and I have a bigger regular IRA and I 401k from when I worked for XYZ 15 years ago. And I think it might even still be there. I don't even know where it is now. So there's all these, like, I call it a collection of portfolios, which are, you absolutely praise, that's the greatest thing in the world. But then what does it all add up to? What's your number, so to speak? How much money will it take to live? Have you thought about how much money you're going to need every year in retirement? Have you thought about the fact that it's going to go up 4 or 5% a year, which a lot of people don't think about? With inflation, we haven't had to deal with inflation for 10, 15 years. And now here it is. So it's reminded us that it's a factor. And so all those things work together where what you really need to really answer your question, you need to have a plan. A plan can be simple or it can be a little more complicated, but a plan is to basically understand how much money you're going to need over the next, let's say you're retiring at age 65, over being the next 30 years easily is how I would forecast. I model out to age 100 just an automatic. If I don't know anything else, I just model out to 100. But if we can get out to 100, we can usually go a little further. But the point is that you have to know what that number is. And it's not hard. I can calculate it in a couple minutes to get a rough idea. But you have to have a plan and you have to know whether what you have is going to get you there. And then you could say, work it backwards. What I have with cash flows and assets, what can I get out of all that? I know how much Social Security is going to pay, but what will my assets, how much can I safely take out of my assets without depleting over a very long period of time? And unfortunately, you're also right that so many people have not saved enough for this day. They have not put enough aside. So it can be very challenging.
Yeah. Anyone, as you said, you deal with people 50 and over. At 50, it's not too late. If they're not going to retire till 62 or 65, they can, if they don't have much saved, they can change that now. And yeah. And
absolutely true. Yeah. You're absolutely right.
And then come to you about how to invest it so that the money they save will then be able to make money as well.
Yeah. And with a 30-year horizon, just even in retirement, I don't know if I really made it clear, but you have to keep investing in retirement. You don't get to stop on the day you turn 65. and have it in cash and say, you obviously there's people that could. I wouldn't say it's a good idea, but they could. They have enough money today to do it. But we really need that money to keep some of that money to keep working because your investment horizon is still long, just as long as it was when you were 40 and at 55. So
That's right. Yeah. There are 10,000 people turning 65 every day in this country. And that's going to keep going for a few more years. And there's starting to be more information as well as misinformation on the internet in particular about how to make sure that we're going to be okay in the financial aspects of retirement. But so can you break down through the noise of it all and tell us what a healthy financial retirement plan really depends on?
yeah, I will, because as I said, it doesn't have to be a plan doesn't have to be complicated, but what it really has to do is be very clear about where you stand today and get every asset and every liability that you have on the table. And that's what we spend time with people. And then thinking about not only where you want to go in terms of income, which is pretty basic, but how you want to do it. What priorities are important in your life? A lot of people tell me travel is, or supporting children with different support needs is often comes up, or one child is fine, so to speak, financially, one isn't. So then you have to figure out how to help the child that isn't without being inequitable and things like that. So there's all these things that come into thinking about your plan, but really good to think about it. You have your values in there. What matters to you? What is, when you have extra money, what's it for? Is it to explore and get new experiences? Things like that are really important to somebody. There's one person I know that travels to Africa on a charitable trip, and that's really important to him. So that's something that I put in the plan because I have to remind myself that's really important to it. And it changes a little bit about what we do on the money, but also really just helps me on why he's doing what he's doing, why he's working, and he's going to retire in a couple of years. Those are things just to think about. I think a plan just needs to be candid. It needs to be where you really get a sense of where you stand right now, where you're trying to go, and what it's going to take. What is interesting about a plan is people say, I'd love to work with you, but I don't really want to have any stocks, or I'd rather just have this, or whatever it is. And that's backwards, because what you really have to do is start with the plan. And the plan will tell us what we need to do on the investment side. If we need growth, we have to find a way to help you invest in stock, even if you haven't had great experiences before or feel like it's an area that you're not excited about being in because of the up. We can help. That's one of our jobs is to, as I said, is behavioral counseling and coaching with our clients to help them deal with, what do I do when I see the red numbers on the screen? What do I do in COVID when things are down a lot and you think, how much more is it going to go down? Because we have no idea when this is going to end. It just started, and all these things run through your head. I've lost money. I've lost 25% of your money is what you could say. And you haven't, not unless you make a bad choice. You don't make a bad choice. We saw that the only thing we really made a mistake with in COVID was assuming it would take 2 years for things to come back. And it really took just a year from a stock market perspective. So from investing perspective, I don't like saying stock market, investing, because we don't invest in everything. The stock market's filled with good things and bad things. We try to just find the good thing.
Right. Yeah. By the way, I want to interrupt you and let everybody know you can have questions in the chat. You can raise your digital hand. We open to your questions, and I got a bunch more to ask Dave, but feel free if there's anything that triggers any thoughts on your part that you want to ask, just make sure that we get them covered. I was at a party recently for somebody that turned 90, and she's hale and hearty and hopefully will live quite a few more years. And you've mentioned that you model things to 100 years. Are people generally anxious about their money lasting that long? And how do you allay their fears about those later years?
Yeah, it's the fastest growing, probably, they always say the fastest growing age group is 100 plus, and I'm sure 90 plus is right there. We know a lot of 90-year-olds. We work with 90-year-olds. So it's a real thing. The life expectancy in the US is just a little bit over, it's around 82, 83 overall. And when you're 65 or you reach 60 or reach 65, your life expectancy from there is much higher. And it's all about planning. Is we can handle windfalls. We can handle when things go better than expected, but not when they go worse than expected. Again, I think the mistake that people can make is to be too conservative with how they have allocated their funds. When, like I said, when you turn 65, there's an assumption that I'm done investing and now I'm spending, and I don't have to be invested in some of the great companies that are in the United States, and I have to be part of that. The answer is usually you do have to stay in there and you have to be invested, and that's okay. That will help you deal with inflation. You're like, if you need $5,000 or $10,000 a month now, by the time you're 90 or 95, it will have tripled in dollars, the amount of spending you will need, even if your standard of living doesn't go up at all. So we're going to need many more dollars than we think. And I think that's where it comes down to. We don't get taught how to do any of this in our school or work or anything. There's no financial education. So why not? Doesn't have to be, it can be in your own way. You can either become a student on your own or have someone help you, so to speak, but to have a plan and know that you know what you have to get done, and to use time as your advantage. Like you said, when you're 50, you have a lot more options available to you. And you don't have to say, it's too late, I should have done this 10 years ago. Then do it now. Take advantage of what you can do, and always be pursuing and in your plan. Get a plan and follow. And it's not necessarily, doesn't have to be hard work, but it has the hard part. Like, think of it. Sometimes people say, why am I paying you? We're not making any changes. We're not doing things. It's like the hardest thing there is to do in investing is stay seated and stay invested. CNBC, we're in a trading world. So over time, it's hard. Important thing is keep hitting and stick to your plan. Have a
Yeah. You're picking up a little bit there, Dave, but hopefully the signal will be good from here on. Okay.
Okay. Yeah, I hope so. Yeah.
Yeah. Technology is great when it works. In most couples, there's one person who takes responsibility for the finances, the investment, the retirement monies, and so on. As we age, it's really essential that each party in a couple knows the ins and outs of our financial lives. So those people who have left their spouse or partner, what would you recommend they do to bring themselves to speed? We're not getting you, Dave. Oh, are you
a little bit. I hope it sounds better. I'm sorry.
Okay.
I hope it's better now.
Okay.
Hope you can hear me. I'm sorry, but
But you're coming in out.
let me try moving a little bit. I think I'm a little far afield here, so I'll move over here where it's a little bit better.
Okay.
I think it's that like the signal might be a little bit better near where I am here. Okay, sorry about it. It looks like there's more bars. Yeah, well, you were asking about couples where usually, and I'd say this happens a lot. One person is more of our primary person. I love it when we've had situations where both people come in and both ask questions, and that's by far the best thing. When we work with new relation, we might talk to one person first, because I know there's like you're calling around or you're picking on things, but then we say we really want to get together have you together as a couple, so we can talk together and ask questions. The same question to both people sometimes is important because they'll have different answers. And there's often cases where I talked with one couple where they were really on different planes. So like completely. And it was too much that we couldn't even really work with them because they were so different from one another. So how do we manage this as marriage as a team, a financial team? And if you're on different pages, it can be hard to for us to work it successfully with them. An advisor can help. Sometimes what I'm thinking of is where maybe over time, one person has been more financially the communicator and then they die. So then the person that's left is saying, what's the deal? I don't know. Bring me up to speed. And that is where having an advisor can be helpful, because we literally can bring them up to speed and we can manage things while they're getting up to speed. Even if they decide to do something else, we can say, we are here to help you and we can tell you everything and tell you why it's been done, all that stuff. But that's not the ideal situation, obviously, versus a situation where you want both people to be fully involved as much as you can.
There are many people who are single, whether they've never married or they're divorced or widowed, which you had referred to. What are some of the issues that are unique to single people regarding financing their retirement?
I would say, I think of it as, because
Okay, hopefully Dave won't be back. We didn't get any of that.
Oh, okay. I'll start again. I apologize.
All right.
With a single person, what we look at is, I guess the thing I always think about is having a game plan that will handle estate planning issues, first of all, where if they become incapacitated or die, is there in one case, we had a client where a professional fiduciary was able to step in and take over, and she didn't have anybody else to help manage her affairs. And this person was able to do that. So truly single in the sense that she didn't have children, she didn't have family around. It was just her. And she was in good health, and then she suddenly got sick, and this person was able to take over in the incapacity phase. And then when she died, she's able to clear her estate out and get the money to where she wanted it to go. So that's one twist that I see versus a couple, is that sometimes those issues need extra care, or you really have to think about who your beneficiaries are, and the people would be there to step in and help in those situations. From an investment point of view, probably similar process. You're looking at a plan, but you're looking at, let's say you don't have any heirs. Like, well, where do you want your money? We need to still manage and grow to support your life, but then where do you want it to? More of a discussion of where do you want it to go after you die. That's always something we talk about, but that's very important for single people.
Yes, because as you pointed out, not everybody has heirs. So if they've got anything to leave, where are they going to leave it and to whom? Yeah, so big question. When we make any transition in life, where we get married, become parents, become empty nesters, we can learn about what's going to happen, but we can't really know what the transition's like until we do it. So in order to help ease that impact when it comes to retirement, as an advisor, what are the two biggest adjustments that you've seen impact clients when they first retire?
That's a really good question. We've seen it happen so many ways. And I think we've just had, the thing, I guess it's a superstition with me, but I think it really helps people, is finding a way to keep going to the office in some way, so to speak, in one way or another. We've had people where they worked full time and then they retired, but we had one client that actually had a little office in our suite and would come in almost every day just for a couple hours to do paperwork and work and have lunch with us and talk to us. And I think that really helped him transition from going cold turkey from retirement. And he did that for over 30 years. And I don't think that's necessary to do for 30 years, but that's what he did. And I think it contributed to his long life and his health, because I think our bodies sometimes, when they don't see a purpose, you don't see like what's next, they can take that as a signal to break down. And I don't want that signal to go out to anybody we work with. So I think of doing some sort of work. It could be a different type of work. It could be volunteer work, or it could be doing what you're doing for your company in a reduced way. But doing something, I think, and I don't even know if I should say getting out of the house to the office, because I know most people don't do that anymore. Like, things have changed. But so to speak, getting out of your personal life into helping another company or helping other people, I think is really valuable. And I think it really helps you as much as it helps anybody else.
Yeah, absolutely. All right. I'd like to start open to our guests. If anyone has any questions for Dave? Yes, Steve.
Yeah, this is relating to portfolio. I heard that the 85% of actively managed investment fund have failed to beat the market, which is like a S&P 500. Then why don't you just invest in S&P 500 index fund and then making a market rate of return rather than going to stockbrokers and so on and so forth? How do you think about investing in S&P 500?
I think it's completely fine. I think our firm does not do it, but there's nothing wrong with investing in an index. It is low cost, as you said, captures everything the stock market that it's focused on will do on the ups or downs. It is difficult to beat the market over long periods of time, but yeah, I think it's a fine way to invest, and many people do it. And the most important thing is to figure out how you need to invest, and hopefully start with a plan to help you decide how much you need to put in certain types of investment. How much should be in stocks, for example. And then if you have, I do believe if you have short-term obligations, say you have to pay for a child's wedding in 3 years and it's a set amount of money, that would be something to get out of the stock market and put into a bond or a fixed investment so that it grows at a slower but predictable rate, and the money's there when you need it. But yeah, no, I think it's fine. We happen to invest in individual stock, and many people do, but many people do. So there's two schools of thought there. I don't know if that answers your question.
Oh, yeah. Thank you very much. And so it is not a bad idea to go with the passive index fund investing, which means that I'm not actually looking at the stock portfolio each day. And I was doing it at the beginning, and then I cannot beat the market. If I do very well, then pretty much it's similar. But I think the main reason is I'm focusing on the short term. When I in the stock market, short term gain, and then just changing the portfolio, and then transaction fee and all those paying all, it just go down to the drain. So basically, I should have a long term policy and stick to it. So more like I need to have some those I'm lacking of. If I go into stock market, oh, this stock will be a blockbuster, and then the all the effort is in there, and then those kind of stock is usually volatility is very high. So when it go down and I try to get rid of it, actually when it go down, I have to buy it rather than selling it. So I'm doing the wrong thing. So those are more like too much emotionally involved. So I thought maybe just to do the passive investing, to just get the all the tension out of my emotion, and then just
Yes.
in the passive investing like S&P 500, and then just leave it there, just don't move anything. So I was thinking about those, and then actually I found a lots of investment advisor like yourself. Probably you are already doing those for your client. And then I was just trying to find out, is any, if I can beat the market, it'll be even better. If somebody can time the market really, then why don't I do that? It seems like it is very difficult to do. So that's where I was not quite sure whether I have to find those people. If I find those people, I'm willing to pay the premium. If they get me the 10% more than market, I will share 5 and half. But it's very difficult to do. So I don't know.
Yeah.
So,
Yes. Steve, my view would be that nobody can, in the short run, the market is unpredictable, and there's nobody out there that can beat it, making rapid trading. And that's speculating, that's not investing. And there are people that have speculated well for periods of time, but there's no reason to speculate with retirement money or long-term money when you can, like you said, put it aside and disconnect yourself from the market the market's ups and downs make us affect how we think about things and affect our behavior. And the more we can be disconnected from that and think long.
Can I hear you?
No, the signal has come out again.
Oh, sorry.
There you go. Yeah.
Yeah.
So you were saying the more we can be connected today.
It's all the things that you've heard. It's being long term and helping by being in. I think for you, Steve, being in index funds makes all the sense in the world, because you just want to be participating in the market to the extent that you need to be invested in stocks. That's a good place to be, and you don't want to look at things too much. We try to tell people we all read too much financial news or market quotes, and it's not good. It's not good for us here. We try not to, we have to do it as our job, but you don't have to do it as a client.
Second question is when the inflation goes up and the interest rate will go up. Usually when interest rate go up, stock market go down, and then bond market even go down as well. So is it better to just put the money in the cash, and then when interest rate go down, buy all the S&P 500 fund, or if I decide to buy the S&P 500, just don't move it at all. Just when you go down, just buy some more, rather than just putting everything in cash.
What's weird about the market is all that news that you talked about, especially interest rates, does affect stocks, but it does it with an overlay that there's thousands or millions of other people thinking the same thing and either deciding to do something or not doing something. So it all means that you don't know what's moving the market at any one time. So the best thing is if you take all your money on and wait for a better environment, let's say lower rates or whatever, the market isn't going to move right in sync with that news. So you want to just keep things in there. When there's a big shock and things go on sale, we call our clients and tell them to put more money in, because everything's on sale. It's exactly like it is at a store. And then holding on to it for the long run as those businesses get more valuable is what really matters, because interest rates move up and down in a cycle, but they don't affect the permanent rate of return you're going to get over a long period of time. And if you're in the stock market, you have to be thinking at least 5 years out for that money.
Okay, thank you. Appreciate it.
Okay,
Thanks.
Any other questions for Dave?
Pauline, can you hear me?
Yes, I can. Go ahead, Kimberly.
Hey, it's Kimberly. Hi, Dave. How are you?
Great, Kimberly. How are you?
I'm good. I really appreciate what you have to say, and I appreciate Pauline hosting the. I am for a combination of reasons positioned financially for my retirement, and so my question is more about service provider. And what I am curious about is your opinion of the benefits of going with private banking versus an investment firm that really does not have banking services. So if you need anything like that, you have to go outside of the investment firm to achieve it. I'm currently with an investment firm, and that is specifically what they are. And I have some opportunities to switch to private banking. And there's just a lot more bells and whistles and things. But I'm just wondering what your take on that is.
Yeah, that's a really good question. And we know a lot of people that are in your position. Our feeling is, and my partner, if he was here, would really have a lot to say, because he's worked for a couple of different investment organizations where they get bought by a bank, which always sounds good. And it does provide more functionality. But I'd say the thought process in the world of investing is a lot different.
Okay. He'll be back any second. You cut off at the world of investment is different than, I assume you were going to say banking.
Yeah, it is. You're right. It's a different business. I'm going to ship over here. I'm so sorry about in there. It's a different world than it is with banking. And I would say, from my perspective, and other people might differ, is that an investment, I would prefer to have my investments with a firm where it was all about investment. And then as my banking and have my banking needs be a little bit separate. They don't work with banks. We send money to our client bank accounts. We have links there, but that's the way I would approach it. I think they're different businesses, and I think it's better to go with a really good bank and a really good how I would sum it up.
So not to put all one's eggs in one basket.
Yeah, it's okay. Well, you should have one advisor that, in my opinion, that handles the majority, if not all, of your net worth, but they don't have to necessarily be, it doesn't necessarily make it better for them to be part of a bank, because I think that the investment culture, to be able to think a little bit differently and make moves, is very different than a bank culture, which is much more about, it's much more conservative culture. So I think it makes, with your investment advisor, you don't want somebody that's doing exactly what everybody else is doing. You want someone that's able to say, what makes sense for you is to do this, not necessarily, and that could be different than someone else, what they would do for somebody else.
I think one of my primary concerns is with the smaller firm, which is a very well-established firm, is, I don't know, I guess I could say perhaps a lack of substance in terms of resources, where I really just know the principal, and the principal of the firm helps me with my portfolio, and I have no relationship with anybody else there. And when he goes, I'm like, there's no infrastructure. There are people there. They tried to match me up with somebody, and it just really didn't work. So the principal took over, and not on my account, I will just tell you. But with a banking structure, there is an infrastructure. There's hierarchy. And so right now I'm like dealing with the principal of a firm. He's wonderful. But past him, I got nothing.
Yeah. I would definitely say that it's a good concern to have. I would be concerned too. And I would want a firm where they had a succession plan in terms of if something happens to person X, who takes over. And really, you want to have a lot of succession planning in general. What if our firm isn't around anymore? There's usually no worry about where your assets are because you use a custodian, but you want someone that's in place, because you want someone you can work with and continue to manage things through any changes.
Yeah, I mean, it does require the development of a relationship and people getting to know each other over an extended period of time, so that they can help make the most prudent decisions about a portfolio. And I believe it's a very legit firm. I do believe they have all their succession plans in place and so on and so forth. And I was working with somebody who was a CF underneath the principal, and she left to go private. And this goes back a couple of years. And the investment firm tried to match me up with another CFA in the firm, and it did not work at all. And so the principal just took over, and that feels a little, I love working with him, but that just feels a little off to me.
Yeah. Not what it's been. You've had to work with a couple different people, it sounds, and it's always a little bit disruptive.
Just super disruptive.
Yeah. So, yeah, I would say that's something you can expect from the firm you're comfortable with. Should have a plan for what's next, or have multiple people that you can talk to, or whatever you're looking for, they should be able to do it. But so I would say that would be, perhaps you might be more thinking of working with a slightly larger firm where there is more redundancy and some resources and things like that. That might be a better fit, it sounds, but
yeah,
I don't know.
Yeah, it's a little awkward, but I'm muscling through it. But I appreciate, do you have a sentiment about private banking generally? You really think that you should just keep your investment firm on one side and do your banking on another side. That's my
I would-
takeaway.
Yeah, that's from my career, and I would say my partner has a longer career, and I know that's the way he feels. That's the reason he started our firm, which is smaller, but it allows us to do our time on talking with clients or working on portfolios. It keeps us out of bureaucracy, and it keeps us from having to sell. Sometimes a bank advisor, so to speak, has to sell a bank investment product to make numbers, or it's all these things where you're like, anytime the word sell is involved, or in my opinion, insurance is involved in terms of your investments, it's not the way I would do things. It's not the way our firm is set up. So we would rather just find a firm of the right size with the right people. And I hate to say it, but maybe talking with another firm or two might give you a sense of, is there another structure where you're just more comfortable about the long run? Because you're very happy there right now, and you want to be relaxed and be able to say, I'm not only comfortable now, but I'll be comfortable in the future. That's what it sounds like to me.
Yeah, I gotcha. Thank you. I really appreciate that, Dave, and
Of course.
we'll take that under advisement. And I'm going to hand the mic back to Pauline.
Okay, thanks, Kimberly, and thanks, Dave. And we're about out of time. And I see your hand up, Steve, but we have to close. As we close, what's one thing you'd like to leave everything with, Dave?
I guess it might be a little repetitive, but it would be to take time to really assess what you're trying to do with your retirement, and feel one thing, it doesn't take long, but to calculate what I would call your number, where it's, if you had this amount of money, you should be able to get through a long retirement, know how far off you are from that number, and then start to use your advantage. Time is your biggest advantage. Even if you feel like you should have done something before, now is the time to do it and take action. And what we find with a lot of investment situations is people reach out to us and then they don't act quickly, because it's never urgent to do anything with this. You can wait if I told you can't wait another day to start investing, you'd say you're nuts. I can wait another day, and things might even be lower tomorrow, which is totally true. But it's the wrong mentality to have, because you really need to say, I need more time. That's the ingredient. That's the biggest ingredient that will fuel my returns in the future, and my ability to make my plan, which is the biggest thing. That's more important than beating the index or doing anything like that. That's a secondary focus. The number one thing is, what's my plan, and how likely am I to get there?
Great. Okay, so I'm going to share my screen as we close out. So I'd look at what's next, given what we've heard here today. So number one is to make some commitments to yourself. So as Dave said, although this is not a life and death if you start investing tomorrow or not, that really making some commitments to yourself is very important. Contact Dave and talk to him about your needs, or find a feisty and fearless over 50 group, or some one-on-one coaching, or sign up for our newsletters. What's next from Retire Happily is we'll be interviewing Regina Locke, who is a professional organizer. That'll be on Tuesday, the 25th. Particularly if you're thinking of downsizing, this will be something that you won't want to miss. And we do have a Feisty and Fearless over 50 circle starting on next Tuesday, actually, Tuesday, June the 11th from 5 to 6:30. We have a couple of spaces left. Let me know if you'd like to talk about whether it's for you. And you can book a free discovery call with me where we can work that out. I'll give you a free assessment. Just drop me an email. Contact Dave. His email is dhutchinson@triadim.com. Or you can call his office. His direct number is up there, or his cell phone. So wishing you much love and laughter. And thank you very much for those of you that were able to be here live. And those of you who are listening later, I hope you've also got a lot of information out here that Dave was able to. Dave, for being here, and thank you, everybody.